Hello everyone, I Dr. Sonam Arora, Assistant Professor, LG Integrated MBA. Welcome you all to the next video session of Subject Banking and Insurance Semester 9 Finance Specialization. Today we are going to discuss about some concept which is related to the insurance sector. Now these concepts are wagering, over insurance, double insurance and reinsurance. So let's look at the first concept of the day, wagering. So when we talk about the wagering contract, it is a contract that parties create the risk and want to make money on the happening or otherwise of an event. For example, we can go and bet for a rain. So I bet tomorrow is going to be rain or not going to be rain. Or we can take the example of a cricket batting. So elements of a wagering contract is an unforeseen event. So we are not sure that event is going to happen or not. There is two parties in a contract and the both parties have an opposite view. So one party used to say that a rain is going to happen and the another party used to say that rain is not going to happen. So such type of contract is called as wagering contract. Now the wagering contract has an element of risk, and when we talk about it insurance is simultaneously having an element of risk. Now what is the difference between a wagering contract and an insurance contract? So look at the difference between the two. The first difference is that an insurance contract is an indemnity contract except the life insurance, whereas wagering, this is a no contract of indemnity at all because there is no concept of a personal loss. Second thing is, in insurance, event occurrence is a contingency. There is no surety that event will happen or not happen. But when we talk about wagering, the event is bound to happen. If event did not happen, the another party is going to win. For example, we talk about the rain. So either is rain going to happen or not going to happen. In both the circumstances, one party is a winner in case of a wagering. So wagering is more close to the gambling. The third thing is, in case of insurance, we protect ourselves against the loss, where in wagering, we take a loss to earn a speculative gain. Event is not desired by one party in case of insurance, whereas in wagering, a party needs to happen that particular event, because if that event did not happen, the party is going to be lost. Another difference is, it presents the insurable interest in case of an insurance, whereas there is no insurable interest in case of a wagering. For example, as a farmer, I go for an agriculture insurance. In case of an agriculture insurance, my insurable interest lies there. But in case of a wagering, there is no insurable interest. So it's simply a betting of a particular event to happen or not to happen. When we talk about insurance, the degree of loss is different. So if the event happens, in case of a life insurance, so we take out the insurance of myself. So in case of death, the degree of loss is high, but there is no case of death, the degree of loss is exactly not existed. But when we talk about the wagering, there is two party and one party is going to win and another party is going to lose. So the basic conceptual difference between insurance and wager is that insurance is a calculative mechanism of transferring risk, whereas wager is simply taking a risk to gain a profit. And the second more important difference is that insurance is a legal mechanism, whereas wagering is illegal in India. Now have a look at the another concept, over insurance. So over insurance can be defined as where an insured has bought so much coverage that it exceeds the actual cash value or the replacement cost of that particular risk or property insured. For example, I insured my house. Now the replacement cost or the actual cash value of my house is 50 lakh rupees. But I took the insurance of 70 lakh rupees. So that extra 20 lakh rupees is over insurance. For the insurance company, over insurance constitute a moral hazard because of the insured may be tempted to make a false claim. Over-insurance result into a compensation to be paid by the insurance company in excess of the actual loss incurred by the insurer, either by the false claim or due to the overvaluation of the insured asset. Now, we will look at one example. I took here the example of an hospital because overinsurance is very common in the business of medical insurance. Mr. X, diagnosed with the cancer, and admitted to the hospital for a surgery. He had a medical policy of rupees 15 lakh from a reputed company. Hospital with a third party agent of a respective insurance company are staking claims for a medical treatment. Thus, the medical treatment is over and above the actual amount. So, the actual amount cost 5 lakh, but with the help of a TPA, they go and charge for the 10 lakh rupees. That extra 5 lakh is in over insurance, and this has happened due to the TPA, hospital and the insured. They together do this particular fraud here. So these are a very frequently observed cases in India that many medical insurance providers stop the cashless facilities and are bent to decide that some basic modalities are required in a cashless medical insurance. Now look at one another example. Mr. Y get insurance of a factory valued of rupees 1 lakh in rupees 15 lakh. It means the cost of my particular factory is just 1 lakh rupees, but I took the insurance of 1 lakh 50,000. That extra 50,000 is my over insurance cost. In case of any mishappening, insured must be under the impression that he would be compensated for the amount insured, that is 1,50,000. But the company is going to pay you only 1 lakh rupees. So the concept of that gaining extra 50,000 is failed here. So over insurance is not a good option either for the insured or the insurer. Coming down on the actual ground, it is found that insurance company find the loss actually incurred and shall be liable to pay the market value of the loss. In these circumstances, insurance company is in the positive side, whereas insured is in the loss, because ultimately he have to fill the premium of rupees 1,50,000 rather than 1 lakh. So the ultimate nutshell is this, that over insurance is not at all a good option either for insured or insurer. Now look at the another concept. Now we are going to discuss about the double insurance. It is a type of insurance where the same subject matter is insured more than once. For example, I took out 3 life insurance policy, each cost of rupees 50,000. So I am insured by 50,000, 50,000 and 50,000, that is 1,50,000 rupees. So I took out the double insurance for myself. This is a case in which my hearers get 1,50,000 rupees. Similarly, insured can take double insurance in life insurance as well as non-life insurance. Now you have to fill the premium for 3 different policies. But the compensation method is different in all the cases. So it is not necessary that every insurance company is going to pay you similarly the other one. So double insurance is again a not very good option. But if you are very much considerate about a particular individual or particular subject matter, then you can go for a double insurance. Now here I want to clear it. If you use the word double insurance, it doesn't mean that double insurance include 2 insurance only. It is more than 2 also. Like I give you an example of 50,000 rupees. Now look at the picture. What this picture suggests here. So there are 4 umbrellas covered with 3 umbrella and again covered with 2 and 1. So this picture suggests you about the reinsurance. Now reinsurance occurs when multiple insurance company share risk by purchasing insurance policies from other insurer to limit their own total loss in case of any disaster or calamity. It is the insurance of the insurance company. For example, I took out my insurance from ICICI Prudential. ICICI Prudential give insurance to many people. Now, when ICICI Prudential take the insurance from the another company, then it is called as reinsurance. This is helpful for the ICICI Prudential to transfer risk and to manage the capital. Now, in India, General Insurance Corporation is the only company which works for the reinsurance. Now, how reinsurance work? We took in one example here. This is an example of an Australian pool corporation. It is one of the very famous company in the business of reinsurance. Now, the insured make a claim to their insurer. For example, I make a claim to the ICICI Prudential. ICICI Prudential make claim to the General Insurance Corporation. Now, General Insurance Corporation pay to ICICI Prudential and ICICI Prudential paid back to me. In this way, this whole process go on. So, there is one insured, one insurer and one reinsurer. In this example, I am insured, ICICI Prudential is insurer and General Insurance Corporation is a reinsurer for the ICICI Prudential. Now, when we go and see the difference between the double insurance and reinsurance, the very first difference is that double insurance include a single object. So, double insurance is an insurance of an individual or a subject matter. For example, I took out the double insurance for myself. Whereas when we talk about the reinsurance, ICICI Prudential take my insurance and GIC take the insurance of ICICI Prudential. So here the subject matter is different. In case of a double insurance, a property is maybe or an individual may be a subject matter. But in case of a reinsurance, only the original insurer is a reinsurer. When we talk about the compensation, in double insurance, it can be claimed with the insurer. Whereas in reinsurance, it can be claimed from the original insurer, whereas the original insurer going to claim it with the reinsurance company. Now, when we talk about the losses, in case of a double insurance, loss will be shared by the insurer in proportion. For example, if I took an insurance policy of myself, one from ICICI Prudential and one from another company, whatever the loss is, it is shared by the both company in a particular proportion decided by them. Whereas when we talk about reinsurance, it can be claimed from the original insurer who will going to claim the same amount from the reinsurer. So ultimately here is the loss of reinsurer. Now when we talk about the insurable interest, the insurable interest is always present in the case of overinsurance and double insurance. Whereas in case of reinsurance, it is not present. When we talk about the aim, the basic aim of double insurance is to ensure the benefit of insurer. Whereas in case of reinsurance, it is there to reduce the risk of an insurer. Thus, we are able to clear out three basic terms here. First is wagering contract, second is double insurance, overinsurance, and the last one is reinsurance. Now, with this particular video session, we are going to end our subject banking and insurance. At last, I am going to tell you, buying insurance cannot change your life at all, but it prevents your lifestyle from being changed. And thus, in this particular time, insurance is very important. Thank you. We'll meet you in next classes.